Hello and welcome to the Weekend Review by the Voiro podcast, episode 11. I am Anand Gopal, and as always, with me is Kavita Shenoy, founder and CEO of Voiro. Hi, Kavita.
Hey Anand, what's happening?
How are you?
It's bubbling over with all this news of Netflix and Snap and advertising just seeing the light of day in a positive way.
Mm-hmm.
So this whole week was a buzz with Netflix's Q2 results. Snap's results came out yesterday, and there's a lot of similarity, I want to say, between what they are saying. Very famously, Reed Hastings went on record with an analyst to say, quote, "Our excitement is tempered by less bad results." I mean, everybody was expecting them to lose 2 million subs, but they lost about 970, about a million. So they kind of set themselves up for a big loss, and then there was a slightly smaller loss. But they're looking to claw back those subscribers with a variety of ways. One is obviously a subsidized version of subscriptions, which is ad supported. And of course, there is charging for households, which I think you're going to shed some light on a little later in the podcast. On the other side, Snap released their results yesterday and they were pretty harsh on themselves. They opened their investor letter saying, "We are not satisfied with the results we are delivering." And the thing with Snap is that they've had and they've enjoyed an annual compounded growth rate of about 50%, since their IPO in 2018. And right now they're kind of dwindling, but they want to make sure that, but they've made some good investments and they want to make sure that they're diversifying their revenue sources. And they want to make sure that with that, they diversify their top line growth. One is obviously doubling down on direct response advertising to deliver measurable results on advertising spending. They have invested heavily on maps. I know you and I are not users of Snapchat.
I could be.
Okay, fine. All right then. So so you can shed some light on this maps thing, I assume. So there's this whole feature of maps where you can actually go to restaurants and use AR to walk through these restaurants and experience things. It sounds very video gamey, but it's extremely engaging. And you can, if you just look at it from a very even a short term view of it, you can see the number of things you could do in terms of advertising. A walkthrough of a restaurant, what all you can place there, the kind of shopping experience you can give people, and there are so many things that you can do it in a digital virtual environment, more like the metaverse. And they also see huge opportunities driven by other AR products that they're coming up with, and of course they have also thrown their hat in the ring with subscription, where they're coming out with Snapchat Plus, which is about $3.99 per month, where you can subscribe to certain types of influencers and content creators, much like television or even on like YouTube and things like that. So the thing that the theme, this is something that we had predicted at Voiro, right? Long time ago, 400 years ago in Voiro, when we started saying that advertising and creating monetizable opportunities through content are several. But the secret sauce is in how the content creator actually manages it, right? And we saw this at the time when YouTube had MCNs and MCNs came together, and they represented all this talent on YouTube, and they collected all their various types of videos, and then they gave them opportunities to write books and give talks and have events and go on stage and become like artists and put them on TV and so on and so forth. And they became almost the talent managers. If you turn that around today to long-standing or large publishers who have like this kind of revenue, 1.5 billion in ad revenue, the kind of experimentation and the number of demand sources that they have to activate concurrently and manage is massive. So having products like Voiro in there actually helps publishers like this. And I'm sure large publishers like Snap or Google or YouTube and Netflix and so on, and all the other publishers have products like Voiro. But I want to know what you think about how publishers can utilize us as a platform in today's day and age, where these behemoths are leading the way on opening several sources of revenue and driving experimentation in the hope that they can create more opportunities for advertisers to interact with their consumers.
I have two words for you: commercial agility. But before that, I must first let it be known that I reject this notion that I am not a snapper. I mean, I
First
might
of
not
all,
be.
it is not Snapper, it
There
is
you
a
go.
Snapchatter.
Snapchatter.
Okay.
So I'm already not
So
it.
you're not even with
Not
it.
it. But the fact that it is an automatic assumption is something I need to
Repair.
check in with my PR folks about this. Two, why are they calling it Snapchat Plus? This plus suffix has got to stop. Everybody is plussing themselves.
I'm going to be Kavita Plus
Yeah,
next week.
people want to know where
I'm gonna be the
Voiro Plus
best
is.
version of
Where is
myself.
Voiro Plus? But I think what we're witnessing with Snapchat, with Netflix, and a lot of these organizations is you spend a lot of your time focusing on your underlying offering, which could be streaming, it could be content, it could be social media, it could be anything that has the ability to offer value to consumers. What do tech companies do? What do tech companies pride themselves on? It is the ability to be technologically agile. Your teams, your technology, your DevOps, your scalability, your caching systems, everything that needs you to scale your product and scale your basket of offerings, which gives value to the people who congregate around your service. But a lot of folks forget that commercial agility is just as important to keep your business viable for the day, not just for the day you want to be profitable, but for you to have a sound business model. We've seen Shark Tank. We are entrepreneurs and we have been through the ringer a few times of pitching to venture capitalists. And one of the earliest mistakes that we ourselves have made, we've seen founders make, is to not focus hard enough on the simple question, which is, how is this going to make money? How are you going to be commercially viable? And I think there is a very strong correlation between being commercially viable in the long term and being commercially agile, which is you could choose to open multiple revenue streams, or you could choose to have the option to drive commercial success through multiple angles. And what that basically means is have multiple revenue models that creates non-linearity in revenue. And what we're seeing with every one of our customers is there is commercial agility at a broad level, which is, can I bring in subscription revenue and be ad supported and use some combination of these to create multiple versions of my product. And two is within advertising. Can I run a direct sales ship? Can I open my product, my audiences, my inventory to the open internet and to the open auction ecosystem? But I don't want to just pick one and assume that that is the solid long-term bet, and if it fails, I have nothing to fall back on. Today, from an advertising standpoint, from a consumer standpoint, commercial agility can change every minute. You can have multiple revenue channels that coexist seamlessly for different groups of audiences, as well as for the same audience, where they want to watch sport, which is ad supported, but premium content, which is subscription driven, or the other way around. What we give our customers is the ability to drive commercial agility and also experiment with new business models, because you never know what's going to work till you try multiple models. And once you try a model and it works, you never know how long it's going to work. And that's pretty much what we offer to customers. And what was most interesting to me with Netflix's results is, I don't know where to begin, because I read their shareholder letter. I was reading Snap's letter along with you. This is board results week at Voiro, which means we penned our own letters, and it was a great learning experience for us to be able to read those letters. The big takeaway was this whole narrative that it was not as bad. And this is also where, the US forces publicly listed companies to offer guidance
And Snap
in
didn't.
advance. Yeah.
Snap declined to
Yeah.
give them a guidance for Q3.
But the fact that they projected to lose 2 million subscribers and then ended up losing 970,000 is something the market collectively breathed a sigh of relief about. I had 4 takeaways from this. The first one is, outside of the broader narrative where the market, bumped their stock up and it was not as bad as expected, they published their results where Latin America and Asia Pacific both came in at about $1 billion each. Latin America has crossed $1 billion and Asia Pacific's about $900 million.
In
Uh, in
subscription revenue?
In revenue.
Okay.
Of subscription revenue.
Yeah.
But from the $7 billion they did, these are two significant chunks because Netflix also launched last week a new business model only piloted in Latin America, which allows you to add a household to your subscription plan. And this is something I really like, not because this is independently agreed, it might not work. But there was an Andreessen Horowitz talk that you and I had watched, I want to say 2020, where they talked about the fact that advertising is not the only route you need to take. And they talked about diversity of revenue and agility. And these are the kind of things I like, is creating new business models, creating new products. The classic revenue management question, which still holds through all of this, is the ability to drive revenue is going to stem from you offering the right product at the right price to the right customer at the right time. Which begs, last week I said, what's a TV? This week I'm going to say, what's an ad? What's a product? You could create different tiers. You could bundle different experiences together and then take that to a different segment of your market, price it differently, and tap into things that your customers want, as opposed to trying to suppress certain types of behavior like password sharing. Two is, it seems interesting to note that while the lower priced ad supported tier might be something that might be aimed at an emerging market, the biggest impact of an ads tier can actually come from within the United States, where CPMs are much higher. Because emerging markets are low yield markets, but are high in supply. So it'll be interesting to see where they take it. If Latin America and Asia Pacific are effectively a seventh of Netflix's revenue, they have chosen to take home sharing as a model to Latin America. I want to know where they'll take their ad-supported model first. And that's something I'd be very keen to watch because it could also cannibalize your own subscribers. People who are paying your full-blown subscription tier might suddenly move to the lower tier. So you don't want that either. So I'd be curious to see how they analyze this and where they pilot it, because that'll be interesting to watch. 3 is, I was also wondering why Netflix is under the sky. Why is everyone talking about them? And I believe it's the fact that they are pioneers. Right? Today, streaming and Netflix are linked together. And when someone is a pioneer, they are a category creator. Maybe they're always going to be under the scanner more because everyone's watching them, everyone's following them. The last thing, I also spent some time this week listening to 2 podcasts that I really like. One is the Good Time Show, where they interviewed Mark Andreessen about a month ago. And 2 is the All In podcast with Sachs, Friedberg, Jason and Chamath, 4 investors, 4 billionaires. And they were talking about market dynamics. And I thought it was particularly interesting in the context of Netflix because the market's been funny. We expected a crash at the start of the pandemic and we got one at the end. Everyone's talking about how streaming and growth at all costs is something the market doesn't like. But you could ask the question, why did the market like it to begin with? And the other question, which we were talking about on our internal Slack channels, is it'll be interesting to see the quarter-over-quarter difference in institutional shareholding of Netflix, because that will tell us who dumped their stock. Was it retail investors who panic and don't know better? Or was it institutional investors, hedge funds?
What would you do? Would you
ETFs?
hold or would you sell?
My risk appetite is very bizarre, but I don't know. I'm not authorized to give financial advice, but I'd hold. If I had Netflix stocks, I'd hold.
Okay.
But interesting set of developments this week, and I'm waiting to see how the other companies that banked on streaming and then realize it's troublesome and are now kind of in between. I want to know how they're going to react to this series of events.
Yeah, that's going to be something that we're going to be watching out for as well. Building a streaming business is really, really tough. I mean, for Netflix to come onto the scene, build an entire library, take on the giants, enter awards that were particularly only for studios and the traditional content creators makes them pioneers. And by that very platform that they hold, they're going to attract this kind of scrutiny. So I think they're prepared for it. And the thing about Netflix and streaming and the fact that they are pioneers and all of these are hard things to do, right? And one of the things that are that we also see in advertising that's hard to do is monetizing live sport, right? In the last 8 years that Voiro has been around, we've been associated with IPL from 2014, when Hotstar wasn't Hotstar. At that point in time, it was just starsports.com, and they were trying to figure out how they can launch an ad-supported live stream model, especially for sports. And sports and news are these two tentpole money spinners for any kind of network, and any network would like to hold both of these portfolios because you have a very discerning, loyal audience for both these types of content. And the other day on LinkedIn, I saw a post, and we all got a little excited about it. FanCast is going to be streaming exclusively India versus West Indies, 3 ODIs and 5 T20s on FanCast, 7 p.m. onwards. And this is specifically to cater to the Indian diaspora in the United States. Now, this is a very, very specific segment of the world population for a very specific sport at a very specific time on a very specific platform. So it has all the makings of a test market, right? Where you can actually kind of ring fence everything and make sure that you're injecting just the right amount of experimentation and come away with some learnings, right? Why are you smiling so much?
Because you said test market. It's because our first iteration of Voiro that was pioneered for the IPL was first put to use in a test match.
Yes, for
if you
T20.
remember.
Correct,
It was
correct,
a test
correct.
match, not even a T20. It was a test match.
Correct. You're right.
These kind of things I like.
All right. So it's the first time. It's not on a private TV channel. It's exclusively on FanCode. And, why is, and the announcement that was made was that this inventory for these 8 matches, 3 ODIs and 5 T20s will be available through DV360. DV360 is Google's DSP. Now, why is this big? Live sports is notoriously difficult to monetize, right? Because you want to maintain the integrity of the live stream in itself. You're not entirely clear about the kind of inventory you're going to get because there is no particular benchmark that you're going to be. You're again looking very suspicious. What do you want to say?
Because I was thinking about how if you don't get it right, sports fans will kill you.
Yes.
On the internet. I have watched ESPN and a lot of companies get this wrong. And the margin for error is so small. If you have a companion where the stream is accompanied by a scoreboard and the stream lags the scoreboard by 2 seconds, don't open Twitter for a few days.
Yes. Not if you are the product manager of that particular app, for sure. So live stream is usually directly sold, right? And we've seen this time and over, whether it's NBC, whether it's Hotstar, whether it's Sony. Everybody has a large sales team trying to back up this whole inventory. It's available on DV360, which means that it's fair game for anybody. It's a very specific audience type, so there's going to be a specific advertiser type running after it. It's Indian diaspora at the end of the day, so you want people who it's an intersection of people who like cricket, who are in the US, who identify with a particular type of brand. So I'm not entirely sure what kind of brands they could be, but we'll see. Like I was saying, the integrity of the live stream cannot be compromised, which is why programmatically available live stream inventory is a shocker. How are they going to do this? And I'm very curious, and it starts today. So I'm going to be on that live stream because I want to know what's going on this live stream.
On FanCast.
Yeah, on FanCast. And it's historically very hard for advertisers to also activate their campaigns because of the unpredictable nature, right, of the stream in itself, the match in itself, and the availability of inventory. What if it gets rained out? What if it gets over fast? But like most apps today, right, which we call our Web3 apps where, commerce is at the center of the application in itself. It's not an afterthought. Like we spoke to somebody the other day, a CTO of a large e-commerce company. He basically said that today apps are being built with advertising as a legitimate source of monetization right at the beginning. It's not an afterthought, it's not an also had or anything of that sort. We are going to make money through advertising, and that's how we're going to sustain ourselves, and this is how we're going to take a share of this already organized advertising market. So similarly, cricket also was developed as a game to be cast on TV as well as on the internet with specific break patterns. So after every ball, you can have an ad unit play. You have a drinks break, and you and I have done this. We've actually placed ads in huge ad breaks for over 100 matches for IPL, and that was when we were trying to play ball along with the TV side. But this is the way cricket is. So cricket is one of the few sports that are streamed live that truly lends itself to advertising, where audiences are expecting it. Live producers on the ground are expecting it. Players, bowlers, umpires, the audience in the live stadium also expect it. There is an ad break. So it's part and parcel of the game, which makes it easier for advertisers to address. But in a programmatic scenario, it still becomes extremely messy. You don't know where you're going to go with. So this is a good place for the industry to start because, like I said, it's so controlled, it's so specific. So your mistakes are small, your gains are massive. The learnings are going to be great from here. I'm waiting to see what comes out of it. I hope Fancast does a good write-up once this is done and we're able to take and start seeing more of this in other sport and other publishers. Okay, so you were gonna do something new
Yes.
on today's podcast.
Yes, I am very excited about
Fire away.
it. I wanted to string together a few things that have been happening at the intersection of sport and money.
Okay.
Okay. There is a show on ESPN called The Jump, where every now and then they do a segment where they table a trend and you're supposed to vote, and you have three options. Is it nothing? Is it something? Or is it everything? Okay. I think we are witnessing something that is hard for me to describe and pinpoint, but I think it's setting the sport industry for something phenomenally large, and I think it's everything. To your point from the previous segment about DV360 and live sport, I read an interesting story on Twitter yesterday about the intersection of sport and money. Okay, so this is the start of my string of stories. Trends, stories, right? Apparently in 1983, Indian cricketers used to get a stipend of 600 rupees per day.
Okay.
And they used to get paid for 3 days, the day before the match, or 200 rupees per day. So 3 days was 600. The day before the match, the day of the match, and the day after the match. And then they used to get food and an additional allowance. And they used to get 2,100 rupees each
For?
to play a match.
Okay.
Okay, this was the Indian cricket team in 1983. And when the Indian national team won the Cricket World Cup at Lord's in London in 1983, the BCCI announced a 1 lakh prize for every player because sentiment and emotion and the value of those players was through the roof. Indira Gandhi, the photographs of Rajiv Gandhi, all of this stuff happened. And apparently they didn't have the money for it.
What? PCCI
They didn't have the money for it
Wow.
at the time.
So who ponied up that money? The government?
So, India's most loyal cricket fan until the day she died was Lata Mangeshkar.
Yes.
And she stepped up and did a concert just to raise money.
Wow.
And she successfully pulled it off. Okay? So this story starts here, where there was a time when this was the relationship between a cricket crazy nation and money. There's a very, very cool newsletter that I subscribe to by Joe Pompliano called The Huddle, which talks about the relationship between sport and money across various sports. He wrote a post yesterday about lacrosse in the United States. And there is this rise of a new league called the PLL, the Premium Lacrosse League. And I was reading it and I was like, oh, well, great. We had the Kabaddi League here in India that spawned a few years ago. But as I was reading the details, he is invested in the league. And so he was saying, here's my investment thesis. One, I noticed that there is already a league, the major league, the MLL, the major league lacrosse, if I'm not mistaken. So this is basically a new league that's trying to upstage an existing league, which has been happening in recent years. Two is, through all of his investment thesis, he ended by basically saying, PLL is basically, to me, a media company. That's it. My radar went up and I was like, I gotta look into this. Okay. And so he talks about the league and kind of how small it is compared to every one of the other sporting leagues that we know and we've been tracking. The last few episodes of our podcast, we've talked about the NHL, we've talked about the NFL, we've talked about the NBA, we've talked about Formula One rights, Major League Soccer rights, and of course the big one, IPL, which we broke down three or four episodes ago. But the PLL is now seeking investment to upstage the existing league, but lacrosse is still early in its year, so this could still be a fight for the first big league for a sport that is not yet globally popular. Okay. There is a league in Southern California called the DOOH League, which last week was suddenly very popular. It happens every summer. It's a pro-am league in California, and it's basically amateurs who play in a organized basketball tournament. But every summer it attracts NBA players who show up and play, and actually, contrary to what you would expect, don't dominate. So the amateurs are actually very, very good basketball players. Last week, the reason it was suddenly popular is because LeBron James showed up.
Ooh.
And he played and he dropped 42 points and he played well, but it was still not easy. Historically, Kobe Bryant, J.R. Smith, Kevin Durant, you name a big player, James Harden, they've all shown up and played the DOOH League. So there's this league that's suddenly popular and is blowing up on social media. In fact, the NBA's official website and YouTube channel and TikTok streamed clips from the DOOH League. I'm not sure how the rights were aligned, but they did it. Suddenly you have this league that's very small, very tiny, but is blowing up all over social media. Okay, so which begs the question, what is the value of a league? Is this a league that can command rights, that can command enough money for rights to stream it, to telecast it? It went straight to the NBA, which is the biggest league in basketball. Okay. The NBA in 2016 saw a sudden explosion in player salaries. Middling, near retirement players chose to stay back in the league for an additional year because in 2016 they went from earning very little compared to successful NBA players to suddenly signing contracts worth $50 million, $60 million, $15 million, $20 million for 3 to 4 year deals. And a lot of players who had hung up their boots, unretired, stayed back for a year, made more money than they had made their entire career thus far, and walked away twice as rich at least. And the reason for this is because that year was the launch of an agreement that was signed 2 years ago, where television rights were the revenue that came from television rights was shared with the players. So suddenly there is this new stream of revenue that was out of reach from the players that was suddenly accessible to them. And the NBA has a players association that's very powerful. So they negotiated this updated version of the collective bargaining agreement and gave each other a lot more revenue. So suddenly, as a sporting personality, you're worth a lot more. And you were talking about this in our first segment, where you said MCNs gave creators the ability to suddenly unlock revenue from multiple sources. So now you're not just saying, I'll play a match for this team and take a salary. You're worth something very different. What is that worth? What is your face worth? And we talked about this 3 weeks ago, where we talked about Duke hiring an executive from Nike, because college players are now saying, what is my NIL worth? My name, my image, my likeness, my likeness.
Likeness, yeah.
So there are a bunch of events that are unfolding across players, agencies. Naomi Osaka launched her own agency. LeBron James has an agency that is run by his childhood friend Rich Paul. LeBron James has a content company. Kevin Durant has a content company and an investment arm. There are now alternate leagues. Live Golf, a controversial golf league, was launched 2 weeks ago, and it has caused a stir because PGA players have left and have been considered or called or accused of being sellouts. But Live Golf gives them something that the PGA never did, which is a guaranteed payout just for playing the tournament. Tiger Woods was offered apparently $900 million just to show up to play at Live Golf. LeBron James's net worth has crossed $1 billion and is one of the highest for an active sports person. He already owns a portion of Liverpool, no connection to his life, the football team. He's looking to buy and own and start a new NBA team in Las Vegas. Spencer Dinwiddie, a fairly less known NBA player, attempted a few years ago to tokenize his own career, where you could invest in his future earnings. If he became a LeBron James, was worth $1 billion today. So he, as Jay-Z famously said, where he said, I'm not a businessman, I'm a businessman, is what LeBron has shown is possible. And someone at the other end of their career, Spencer Dinwiddie, is trying to create for themselves. I read this week that IPL franchises have started to buy and own leagues in other countries with the same name. So there's the Chennai Super Kings, who 2 years ago became a unicorn themselves. And now there's the Johannesburg Super Kings. So it's a sister sports team owned by the Chennai Super Kings. There have been technical papers documented about how much an inch of space on a Formula One car is worth. I think this story, from 2,100 rupees and Lata Mangeshkar having to put up a concert just to raise funds for a commitment the BCCI made, and that commitment was made on the back of the fact that sport and sports people and content and attention is worth so much more than what is today on their paycheck. All the way to what we are witnessing today, where sports is effectively becoming attention and media, where a small league in a corner of California can attract the highest paid basketball player in history, LeBron James, where Live Golf and the PLL can basically say, I want to create my own league and take over the big leagues of this sport, are all pointing to the fact that, as Unmish put it, there are fans of the sport, there are consumers of the sport, there are citizens of the sport. And sport connected to media, connected to money, is fundamentally becoming something beautiful that we are witnessing. And I think this is going to just change sport the way we know it. So is it something? Is it nothing? Or is it everything?
It's everything. It's everything. I think it's
Success.
everything. And thank you for that extremely detailed timeline of how you are presenting this whole trend. But it's been building up to this. You see it even in our daily lives. We see friends and family pulling their kids out of regular school so that they can go become semi or pro players in badminton or in golf, or move continents to go and pursue football. Because there are careers and career streams that are there today in sport. We see CTV being able to spawn fast channels where you're able to stream hyper-local events. You can have an event in Jakarta for your particular league, and you can stream and create a pop-up channel where you can get advertisers, and you can actually create a nice, tidy sum of money and a nice little media package around that particular sport, which was never there before. Lata Mangeshkar having a fundraiser event is our woeful lack of technology at that time, and it's a great story. To today, sports people taking to being brand ambassadors, because now they can speak for themselves, because they don't need another artist to be able to drum up attention.
100%.
Right? So you're right. The attention economy is here to stay. And speaking of attention, you have something on Out of Home.
Yes. I wanted to finish up with this one piece. For some reason, 3 or 4 times this week, I saw articles that talked about the resurrection or the untapped opportunity in digital out of home. Out of home has always been a media channel that has been, I don't want to say frowned upon, but it's been viewed very differently simply because of the sheer lack of data and measurement that comes from it. So the Exchange Wire published 2 articles today that basically said, A, it's an untapped opportunity, and B, they've started this series called Mad Tech Sketches, where they drew out Uber's opportunity. It's a beautiful sketch where they talked about how Uber can actually tap into, Uber's doing $100 million a year today in ad revenue, and they're projected to do 10 times that by 2024. So they're going to do $1 billion in ad revenue. And Exchange Wire believes that one of the secrets to being able to hit $1 billion is going to be their ability to tap into digital out of home as a source of ad revenue that a lot of people might ignore. When I think of digital out of home, I think of folks like Times OOH. I think of Vyoma Media, JC Deco, a lot of organizations that have typically had significant control over outdoor space. And I was talking to our colleague Rohan many years ago about out of home, and he gave me a very interesting analogy where he said, look, in line with commercial agility, marketers have to realize, and many of the most successful marketers do, which is the fact that you can't expect the same thing out of every type of advertisement. You can't expect the same thing out of every ad format. Yes, out of home lacks certain things, which is why it will never attract a digital wallet. It will never attract spend from another medium that gives you something else. But out of home has native benefits that cannot be given by somebody else. And there's a very famous example of a British Airways out of home campaign that was very well received in the UK. And it was called Look Up. So they had a digital billboard placed in London, if I'm not, or placed in various locations. And every time a British Airways plane went overhead, it would light up. And there's a child who would point up at the sky and it would say, look up, that's BA 475 coming from Barcelona. And you cannot get that in any other ad format. And so Uber's opportunity is the fact that they have access to real time location. And inside their cars, they have enough data about that passenger, that driver, that location. And in many ways, the shifting definition of the metaverse is the fact that the metaverse has different avatars, and we're still so early in its days that nobody knows, even though it's a 40-year-old term. But one way to look at the metaverse is, virtual reality and augmented reality. Another way to look at the metaverse is to say it is a point in time when we are more online than we are offline. Another way to look at the metaverse is to say that the internet is surrounding us, as opposed to us going to the internet and logging on to the internet. And if Uber can surround you when you're in your car, you have not really logged on to it. You're just sitting in the Uber. And in many ways, their ability to then convert this, use your location data to advertise to you on the screen in the car is a beautiful evolution of digital out of home. So to use Rohan's analogy, different channels of advertising, digital, traditional, out of home, digital, out of home, are basically like a set of golf clubs. And if you're a golfer, you pick the club that you need for that situation. Similar to what we were talking about when we spoke about TikTok and DOOH when we were at AdTech. You customize your message and your return that you expect based on the channel that you are going to use. And so I like what we're seeing with digital out of edge, and I think it has some interesting potential.
I love it. I love it. I think today's episode has been really, really interesting. And I know that everybody else over here listening also has been listening with rapt attention. You're on fire today, Anand, with all the research that you did this week. I love the analogy of the internet being around was like a nice warm hug versus us going into the internet. It sounds far more positive. That brings us to the end of today's episode 11. There's lots to be unpacked again within what we have said, and I'd love to hear back from if anybody's listening to this. Is anybody listening to this? And I'd love to hear back from everybody, and we want to know more of what you want to hear. Till next week. Bye.
Bye. Thank you.